Millionaires are walking away from million-dollar machines. Lamborghinis that sold for $500,000 last year are begging for buyers at $300,000. Ferraris sit abandoned in showrooms while Bentleys collect dust like forgotten relics. This isn't just a market correction, it's the complete collapse of luxury car culture. And if you think this only affects the ultra-wealthy, think again. The shockwaves are already hitting your neighborhood dealer, your retirement fund, and your daily commute. What caused billionaires to suddenly treat supercars like toxic waste? How deep will this crash go before it stops? And why are the smartest investors already running for the exits? The $2 million meltdown has begun, and nobody saw it coming. Before we dive into this collapse, smash that subscribe button because we're giving away 2 Formula 1 tickets when we hit 1,000 subscribers. You don't want to miss this giveaway, and you definitely don't want to miss what's coming next in this market crash. Auction house carnage. The bloodbath began quietly in auction houses where 7-figure sales once made headlines. By late 2024, those same venues reported something unprecedented. No sale rates are climbing past 60% for vehicles worth more than $200,000. Wholesale values collapsed by 18% in just months, turning yesterday's appreciated assets into today's financial nightmares. A McLaren 720S that commanded $350,000 in 2023 struggles to find buyers at $220,000. Lamborghini Huracáns that appreciated for years now depreciate faster than economy cars. The math is devastating for owners who leverage their wealth to buy at peak prices. Dealers who once fought for allocation slots now refuse luxury trade-ins entirely. Their lots overflow with inventory nobody wants, while financing costs drain profits daily. The most exclusive brands, the ones that built empires on scarcity and desire, suddenly face the reality that scarcity means nothing when desire evaporates. This isn't seasonal variation or economic uncertainty. This is a structural collapse. The foundation that supported luxury car values for decades cracked under pressures nobody anticipated. And the crack is spreading faster than anyone imagined. But the real shock isn't the numbers. It's who's walking away and why their departure signals something far more dangerous than a simple market downturn. The Great Wealth Migration. The millionaire exodus started with whispers in private wealth management meetings. Clients who once bragged about their car collections began asking different questions. Instead of, "What should I buy next?" they asked, "How fast can I liquidate?" The shift wasn't gradual. It was sudden, decisive, and devastating. High net worth individuals who treated supercars as portfolio diversification suddenly viewed them as concentrated risk. The same people who drove demand for decades became the force destroying it. The reasons were coldly calculated. Luxury cars that once appreciated 10 to 15% annually started losing value at twice that rate. Maintenance costs on exotic vehicles reached absurd levels while insurance premiums doubled. Electric hypercars promised performance that made gas-powered supercars look antiquated overnight. Why own a depreciating Ferrari when a Tesla Plaid delivers similar thrills for a fraction of the cost and none of the complexity? Wealth managers accelerated the exodus by presenting hard data. A diversified portfolio returned 12% while the average supercar lost 25% in value. The choice became obvious. Celebrity collections went quietly to auction while business moguls moved money into real estate and index funds. Social media posts featuring garage tours disappeared as owners tried to exit before losses mounted further. The cultural cachet that once justified irrational prices couldn't compete with rational mathematics. When the smart money moves, markets collapse. And the smartest money was already gone. The retreat of American millionaires created an opportunity for global competitors, but even that lifeline proved temporary as international markets faced their own reckonings. German engineering's darkest hour. German engineering has built a reputation over decades, but reputation can't stop depreciation. BMW 7 Series sedans, Mercedes S-Class flagships, and Audi A8 luxury liners face the harshest correction in their history. These vehicles once symbolized achievement and sophistication. Today, they symbolize financial loss on a scale that shocks even seasoned dealers. The numbers tell a brutal story that German executives are scrambling to contain. A new BMW 7 Series costs $100,000 but loses $35,000 in value within 12 months. The S-Class, once the gold standard for executive transport, suffers similar devastation as buyers abandon traditional luxury for electric alternatives. Audi faces the worst decline of all three, with sales dropping 12% year-over-year and only 3 models showing any growth. The brand that promised Vorsprung durch Technik now struggles with Rückgang durch Realität. Lease returns amplify the crisis as 3-year-old luxury vehicles flood the market. Former lessees walk away rather than buy cars worth less than their residual values. Certified pre-owned programs collapse under the weight of inventory that dealers can't move at any price. The German strategy of premium pricing, supported by superior engineering, encounters the reality that consumers no longer equate complexity with value. Simplicity, efficiency, and affordability trump heritage when bank accounts are involved. The meltdown spreads beyond individual models to entire brand identities as consumers question whether German luxury delivers value equal to its price. That question, once unthinkable, now drives purchasing decisions across every segment. But the German collapse looks gentle compared to what's happening in the rarefied world of supercars, where million-dollar investments have become million-dollar mistakes. Million-dollar graveyards. Drive past any exotic car dealer today and witness automotive graveyards disguised as showrooms. Rows of Lamborghinis, Ferraris, and McLarens bask in fluorescent light while gathering dust. These machines, designed to embody speed and desire, now represent stagnation and desperation. Sticker prices that once seemed reasonable at $300,000 or $500,000 now look like artifacts from a delusional era. The reality is harsh. Nobody wants to pay yesterday's prices for tomorrow's problems. High-end inventory sits unsold for 220 days or more, bleeding financing costs that dealers can no longer absorb. Every day a supercar remains unsold costs dealers hundreds in floor plan charges while market values continue declining. The mathematics force desperate measures. Discounts that would have been impossible 2 years ago become standard operating procedure. Cash incentives, extended warranties, and maintenance packages get thrown in just to move metal. Insurance costs compound the crisis as underwriters recognize the volatility. Premium increases of 40 to 60% make ownership prohibitively expensive, even for wealthy buyers. Registration fees, exotic maintenance requirements, and depreciation combine into total cost of ownership calculations that terrify accountants. The dream of supercar ownership becomes a financial nightmare where every mile driven costs hundreds in depreciation. Auction houses report similar devastation as reserve prices get slashed repeatedly. Vehicles that generated bidding wars 18 months ago fail to meet lowered reserves today. The secondary market that once supported new car values collapses under its own weight. Without strong resale values, financing becomes impossible and new sales evaporate. The ecosystem that created supercar demand destroys itself through its own excess. Yet even this collapse pales compared to the technological disruption that's rewriting the rules of automotive desirability. The electric revolution. Technology doesn't negotiate with tradition. While gas-powered supercars struggle with image and value, electric hypercars deliver performance that makes combustion engines look quaint. The Rimac Nevera accelerates faster than any McLaren, while the Lucid Sapphire outpaces most Ferraris in straight-line speed. Suddenly, the roar of a V12 sounds less like power and more like inefficiency. The shift isn't just about performance, it's about relevance in an increasingly electric world. Chinese manufacturers compound the disruption with luxury vehicles priced 50% below German equivalents. BYD, NIO, and XPeng deliver features and quality that would have cost $150,000 from BMW for $75,000 or less. The value proposition becomes undeniable when functionality matters more than badge prestige. Traditional luxury brands spent decades training consumers to pay premiums for engineering. Chinese brands offer superior engineering at economy prices. Subscription models attack ownership from another angle. Why buy a depreciating asset when monthly fees provide access to multiple vehicles? Companies like Care by Volvo and BMW's Access program let consumers experience luxury without ownership risk. The psychological shift from possession to access undermines the fundamental premise of car collecting. When access provides the same status as ownership, ownership loses its appeal. Software-defined vehicles change the upgrade cycle entirely. Instead of buying new cars for new features, owners download updates that improve existing cars. Tesla pioneered this approach, and legacy manufacturers scramble to match it. The result is longer ownership cycles and reduced demand for new vehicles. Technology that was supposed to create demand instead extends product life cycles and reduces replacement frequency. The convergence of these disruptions creates a perfect storm for traditional luxury cars. Better performance, lower prices, flexible access, and perpetual upgrades combine to make conventional ownership look outdated. Early adopters who embrace these changes benefit while holdouts face mounting losses. As technology reshapes consumer expectations, even the traditional refuge of classic car collecting offers no sanctuary from the broader market collapse. Collector's nightmare. Classic car auctions once provided stability when new car markets faltered. Not anymore. Prestigious events like Barrett-Jackson and RM Sotheby's report no sale rates exceeding 60% for vehicles over $200,000. Cars that appreciated steadily for decades now struggle to find buyers at any price. The collector market that seemed immune to economic cycles proves just as vulnerable as any other segment when confidence evaporates. Investment funds that treated classic cars as alternative assets liquidate portfolios at devastating losses. Barrett-Jackson's recent auction saw a 1967 Shelby GT500 fail to meet its $150,000 reserve after selling for $280,000 just 2 years prior. A Ferrari 250 GT that traded for $400,000 in 2022 couldn't find a buyer at $240,000. These aren't isolated examples. They're a systematic destruction of a market built on speculation rather than utility. Museums face an unexpected crisis as wealthy donors attempt to offload collections through charitable donations. Institutions that once competed for rare vehicles now decline gifts they can't afford to maintain or display. Storage costs, insurance premiums, and conservation requirements make acquisitions financially impossible. The cultural institutions meant to preserve automotive heritage become victims of the same forces destroying commercial markets. The psychological impact spreads beyond financial losses. Collectors who built identities around their cars face existential questions about value and meaning. Social media accounts dedicated to garage tours disappear as owners retreat from public displays of depreciating assets. Car shows report declining participation, while online forums transform from celebration platforms into support groups for financial loss. Private wealth managers accelerate the exodus by presenting alternative investments with superior returns and lower risk. Real estate, art, and traditional securities offer appreciation potential without maintenance costs or depreciation anxiety. The rational choice becomes obvious even for passionate enthusiasts. When emotion conflicts with economics, economics usually wins. The collapse of collector confidence creates downward spirals that feed on themselves. As prices fall, more owners panic and sell, driving prices lower still. The market that seemed infinitely resilient proves fragile when tested by coordinated selling pressure. But the most dangerous aspect of this collapse isn't what's happening now. It's what's already planned for the future, and most buyers have no idea what's coming. The 2026 Reset Bomb. The most devastating blow to current luxury car values hasn't happened yet. It's scheduled for 2026, and it's already locked into production plans across every major manufacturer. Internal documents reveal strategies that will make today's prices look like historical curiosities. BMW, Mercedes, Audi, and even exotic manufacturers are preparing model lines designed around one central goal: dramatic cost reduction. These aren't minor refreshes or trim-level adjustments. They're complete reimaginations of what luxury cars can cost while maintaining essential functionality. The strategy mirrors what happened in the truck market, but targets an even more vulnerable segment. Luxury car buyers who pay $100,000 today will discover that equivalent vehicles cost $60,000 in 2026. The difference won't be in quality or features. It will be in manufacturing efficiency, simplified options, and realistic profit margins. Buyers who purchase now face depreciation that extends far beyond normal market forces. They face obsolescence by design. Early leaks suggest Mercedes will launch an S-Class variant priced 40% below current models, while BMW tests stripped down 7 Series configurations that eliminate luxury excess in favor of essential functionality. Audi's internal memos reference value optimization strategies that prioritize utility over prestige. Even Ferrari reportedly explores entry-level models that undercut their current lineup by massive margins. The implications terrify current owners who understand the mathematics. A buyer spending $150,000 today risks watching equivalent new vehicles sell for $90,000 within 24 months. That's not depreciation. That's market destruction. Financing becomes impossible when loan values exceed reasonable market prices. Insurance companies withdraw coverage for vehicles whose replacement costs exceed logical limits. The reset isn't just about pricing. It's about the fundamental relationship between luxury cars and rational ownership. Manufacturers bet they can survive the interim chaos by maintaining cash flow until the reset stabilizes demand. But current buyers bear the cost of this strategy through accelerated depreciation and negative equity positions that may never recover. The 2026 reset promises to restore market sanity, but the transition period punishes everyone who bought during the peak years. Industry insiders whisper warnings to close associates. Wait for the reset. The public marketing maintains optimism while private conversations acknowledge the reality. Current inventory represents the last generation of overpriced luxury vehicles before sanity returns to the market. The final reckoning. The luxury car collapse represents more than a market correction. It exposes the hollow foundations of an industry built on image rather than value. For decades, manufacturers conditioned consumers to equate price with quality, complexity with superiority, and exclusivity with desirability. That conditioning created artificial demand that supported unsustainable prices. When economic pressure forced rational evaluation, the entire structure collapsed. The collapse teaches harsh lessons about asset value and market psychology. Luxury cars that seemed like safe investments prove as volatile as penny stocks when confidence disappears. Diversification strategies that included exotic vehicles as portfolio components fail when correlations converge toward negative territory. The same forces that drove appreciation reverse to create devastating depreciation. Smart money recognizes the signs and adapts accordingly. Wealth managers counsel clients to exit automotive investments while values retain any substance. Private equity funds liquidate car-related holdings before losses compound further. Hedge funds short automotive stocks and luxury goods companies tied to discretionary spending. The institutional response accelerates individual panic and magnifies market distortions. Recovery requires fundamental changes in how luxury cars are priced, marketed, and perceived. Manufacturers must abandon premium pricing strategies that assume infinite price elasticity. Consumers must evaluate vehicles based on utility rather than status. Dealers must operate with realistic inventory levels and sustainable margins. The entire ecosystem needs restructuring around rational economic principles. The timeline for recovery extends beyond typical market cycles because the disruption affects cultural attitudes as much as financial calculations. Rebuilding confidence in luxury car ownership requires proving that value equations make sense over extended periods. That proof comes only through consistent performance across multiple economic environments. Based on historical precedent, confidence restoration takes years, not months. Current market conditions offer opportunities for buyers who understand the dynamics and can time their purchases strategically. Waiting for maximum desperation creates the best negotiating positions, while buying during the 2026 reset provides optimal value. The key is recognizing that luxury car ownership follows economic cycles like any other discretionary purchase. Understanding those cycles enables profitable participation rather than devastating losses. The luxury car collapse reveals fundamental truths about markets, value, and consumer behavior. When artificial scarcity meets real financial pressure, reality always wins. When status symbols become financial liabilities, rational actors prioritize economics over emotion. When entire market segments become unsustainable, correction becomes inevitable regardless of how painful the adjustment proves for participants. The collapse continues, but the endpoint approaches. Those who recognize the signs and adapt accordingly will prosper, while those who cling to outdated assumptions will face continued losses. The choice belongs to individual market participants, but the market itself has already decided. The era of irrational luxury car pricing is ending, and the reset will determine who survives the transition. You've witnessed the collapse that most people don't even know is happening, but this is just the beginning. The next wave will hit electric vehicles, and the carnage will be even worse. Hit that subscribe button right now because when we reach 1,000 subscribers, we're giving away 2 Formula 1 tickets to 1 lucky subscriber. Don't miss out on the giveaway, and don't miss the next crash that's already building momentum. Subscribe now because the automotive world is about to change forever, and you'll want front row seats to the action.